Both Chad and Kevin are 30 years old. Both spent 5 years grinding, saving every dollar they could spare. And both of them just hit the same milestone, $50,000 sitting in a bank account, waiting to be put to work. That's where the similarity ends, because what each of them does next sets off two completely different financial lives. Chad drives to a closing appointment and walks out holding the keys to a $250,000 brick rental house. Kevin opens his brokerage app at a coffee shop and taps confirm on a $50,000 order for an S&P 500 index fund. Same starting line, but completely different races. The first thing worth understanding about Chad's move is that he didn't really spend $50,000. He used it. By putting that money down on a $250,000 property, he's now in control of an asset 5 times larger than the cash he actually had. That's called leverage, and it changes the math pretty dramatically. If that house appreciates just 3% in a year, the gain is $7,500 on a $250,000 asset. But Chad only put in $50,000, so his actual return on that investment is closer to 15%. Kevin's situation looks different on paper. His $50,000 grows at the same 3%, and he earns $1,500. That's not nothing, but it's not 15% either. The trade-off is that Kevin controls every dollar of what he owns, and he didn't have to borrow a cent to get started. Day one already creates a gap, and it doesn't favor Chad. Closing costs on a house, loan points, title insurance, inspections, fees typically run around $7,000. So while Kevin's account reads $50,000 the moment he buys in, Chad's net worth has already dropped before his tenant moves in. Kevin also paid 0 commission to make his purchase. That difference matters more than it sounds, because it takes time just to get back to even. Liquidity is the other thing that separates them immediately. A month in, imagine both of them suddenly needing $10,000. Kevin logs into his account, hits sell, and has cash within 2 days. Chad, on the other hand, is what people call house rich and cash poor. His equity is locked inside walls and a roof. Getting it out means either qualifying for a home equity line of credit or waiting out of a 6-month sale process. One of them has options while the other one has a really nice brick house. Chad's first decade as a landlord is a slow grind. His tenant pays $1,800 a month in rent, but between the mortgage, property taxes, and insurance, he's spending about $1,650 just to cover the basics. The commonly used 1% rule for annual maintenance costs adds another $208 a month on average. When the numbers shake out, Chad is actually losing around $58 per month. He's subsidizing the tenant in exchange for something that isn't showing up in his bank account yet, which is equity building quietly in the background. Kevin's version of stress looks totally different. By year 5, his portfolio has grown to around $105,000. Then the market drops 20%. His brokerage app now says $84,000, and that number is real and updates every second that the market is open. Chad's stress comes in the form of a leaky roof or a broken furnace. Kevin's stress comes in the form of a blinking number and temptation to make it stop by selling. These are genuinely different psychological challenges, and which one someone can handle better says a lot about which path makes sense for them. There's a part of Chad's situation that doesn't get enough attention in casual conversation though, and it's called depreciation. The IRS allows landlords to write off the gradual wear and tear of a building over 27.5 years. On a $200,000 building value, that works out to a paper loss of $606 a month. Chad's rental might be generating a small positive cash flow before this write-off, but after applying it, his taxable income from the property can actually show as a negative. In practice, this means Chad might pay nothing in taxes on his rental income, while Kevin is paying taxes on every dividend his index fund pays him. It's not glamorous, but it's one of the most consistent advantages real estate holds over the stock market. By year 12, Chad's house has grown to roughly $350,000. The mortgage balance has come down, so his equity is around $200,000. Most people at this point think about cashing out, but But Chad doesn't. Instead, he uses something called a 1031 exchange, which is a section of the tax code that lets you sell one investment property and roll the proceeds directly into a new one without paying capital gains taxes immediately. He finds a 4-unit building worth $500,000, completes the swap, and defers what would have been over $20,000 in taxes. The government essentially gave him an interest-free loan in the form of money he never had to send to the IRS. Kevin, around the same time, decides to rebalance his portfolio. He's been in the S&P 500 for over a decade and wants to shift some money into a different sector. So he sells a portion of his holdings, and the IRS immediately takes 15% of whatever gains he realized. Chad is playing with gross dollars, while Kevin is playing with net dollars. Over years and decades, that distinction compounds into a very large number. After 20 years, both of them are genuinely in a strong position, just in completely different ways. Chad has traded up along the way, and his real estate portfolio is now worth over $750,000. He still has about $300,000 in debt sitting against those properties, which leaves him with $450,000 in equity. Kevin's portfolio, fed by that original $50,000 plus consistent monthly contributions over 2 decades, has grown to roughly $570,000, and he owes nothing. On paper, Kevin actually has more accessible wealth, but Chad's story gets complicated when you look at what happens if he ever tries to cash out. All those years of depreciation deductions don't disappear when he sells. The IRS comes back for them through something called depreciation recapture, taxed at 25%. On top of that, the capital gains he deferred through 1031 exchanges come due. Chad's empire looks large, but a significant chunk of it is technically already owed to the government. He just hasn't written them a check yet. Kevin can have $100,000 in his bank account by Wednesday if he wants it. Chad has built something bigger in some ways, but accessing it is a whole production. Neither situation is better in an absolute sense. They're just optimized for different things. Here's where Chad's strategy gets genuinely interesting and a little counterintuitive. His plan was never to sell. He just keeps exchanging, swapping properties for larger ones, and deferring taxes indefinitely. Eventually, those properties go into a living trust, and then, when Chad passes them on to his kids, something called a step-up in basis kicks in. Say Chad originally bought that first house for $250,000. By the time his kids inherit his real estate portfolio, the properties are worth $1.5 million. The IRS resets the cost basis, which is the number the government uses to calculate gains. So the $1.25 million in gains and every dollar of deferred tax that built up over the 30 years essentially vanishes once his kids receive the inheritance. And guess what? His kids can sell the next day and own nothing. Chad used the tax code to build wealth the way a bank builds wealth, with other people's money in a very long time horizon. Kevin's kids can inherit a portfolio too, and it's a solid one. But tax leakage over the decades, capital gains from rebalancing, taxes on dividends, and so on gradually erodes the total. It's not dramatic, but it's consistent. Chad's kids get the compounding effect of money that was never taken out to pay taxes. Kevin's kids get something cleaner and simpler, just a bit smaller. Neither Chad nor Kevin made a bad decision. They made different decisions that suit different kinds of people. Stocks reward patience and emotional discipline. The work is mostly just not panicking. Real estate rewards time, attention, and the ability to deal with physical problems in the real world. The tax advantages are real, but so is the effort required to capture them. And there's even a middle path worth mentioning. Real estate investment trusts, commonly called REITs, let someone invest in real estate the way Kevin invests in stocks, through a brokerage account, no tenants, no maintenance, and no 1031 paperwork. The returns and the tax treatment are different, and there's no leverage, but it gives someone exposure to real estate without ever picking up a wrench. The honest answer is that the right choice between these two paths depends almost entirely on what someone is willing to do with their time and what kinds of stress they can actually tolerate. The math can be modeled 100 different ways, but the person who picks the strategy they can stick with for 20 years is almost always going to beat the person who picked the theoretically superior strategy and quit in under 4 years.